It's Andrew Stotts of A Stotts Investment Research, where we're talking about how to become financially world-class. This is part 3. The tool that we use is world-class benchmarking. It's simple, focused, and team building. It helps you balance the competing pressures of profitability and growth. Its focus on profitable growth increases the value of your business. It is challenging to be world-class. You must beat global peers. And finally, the world-class benchmarking triangle is easy to understand and apply. Now let's talk about part 3. Its focus on profitable growth increases the value of your business. Now remember that finance is complicated, scattered, and individual. I developed world-class benchmarking to take complicated to simple, scattered to focused, and individual to team. So which matters more, profitability or growth? Since profitability and growth are opposing forces, management teams usually focus on one more than the other. So the question to be answered is, which of these opposing forces increases the value of a business more, profitability or growth? Let's study it to find out. We started with a universe of all stocks listed in the stock markets worldwide. That's 27,000 companies over 20 years from 1997 to 2016. Then we removed financial companies, meaning banks, which left us with 23,500 non-financial companies. From that, we removed 4,000 stocks that did not have complete financial data, so we couldn't do the analysis on them. So we conducted the study on an average of 4,500 stocks per year. We eliminated companies smaller than 500 million US. We eliminated extreme outliers, which means we excluded stocks that had a price rise of more than 500% or a loss of worse than negative 80% in any 1 year. And we only moved them, of course, for that 1 year. After narrowing and cleaning the data, we conducted the study on the average of 4,500 stocks per year. So let's take an example of a year that had 4,500 companies in our universe. Let's call that year 1. We ranked all of those companies in that year from best to worst on profitability. Then once we did that ranking, we split them into deciles, and that means 10 separate groups, and this would mean 450 in each group. The higher the place in the decile ranking, the higher the profitability. Imagine we bought, now here's where the testing comes in. Imagine that we bought shares in the stock market in all 450 of the most profitable companies and held them for 1 year. At the end of that year, we re-ranked all companies and held only the top decile. The objective was to hold only the highest profitability stocks each year. We kicked out ones that were falling in profitability, and we brought in ones that were rising, but never more than 450 for this case. We repeated this process over 20 years and measured how much the money that would have been invested grew. Let's examine the results. We start the analysis by creating a benchmark. Imagine we've invested $100 million equally in all 4,500 companies and let it grow for 20 years. This is not the group of the most profitable companies, nor the group of the fastest growth companies. Rather, it's all companies. So that's our benchmark to beat. What would be the result of that investment over 20 years? $100 million invested equally in all 4,500 companies each year over 20 years. Well, it wasn't a great period of time for the stock market. What you would have ended up at the end of that 20 years is with $342 million. Not that much. On average, an annual return of 5%. So the next question is, which matters more, profitability or growth? Now that we have established a benchmark, we can begin to answer our question of which of these opposing forces increases the value of a business more, profitability or growth? Would you vote for profitability, or would you vote for growth? Think about it for a moment while I take a cup of tea. So what would you vote for? Profitability, get a high profit margin? Well, that would slow growth. Or growth, grow at all costs. If you could only choose one of those two, which one would you choose? You got your choice? All right, let's continue on. Now, let's test profitability, which I also called strongest. What if each year we invested in only the companies that rank best for profitability, rebalancing that group of stocks each year, kicking out companies that had fallen in their profitability ranking, and adding companies that had risen to the highest profitability ranking? Would we end up with more or less than the 342 of the benchmark? Well, we should end up with more, right? Because we're picking the highest profitability companies. So high profitability companies grew to be more than 2 times the benchmark. Investing in these companies caused $100 million to grow to $772 million. Boom, we've learned something there. We prefer high profitability over the universe. It's a 10% annual return, beating the benchmark by more than 2 times. High profitability beats the benchmark. All right, now the benchmark grew to 342. That's up 5% per year. High profitability stocks grew to 772 million, up 10%. What if each year we invested in only the companies that rank best for growth, rebalancing that group of stocks each year, kicking out companies that had fallen in the growth ranking and adding companies that had risen to the highest growth ranking? Would we end up with more or less than the benchmark 342? Would it be more or less than highest profitability companies ending value of 772? If you voted for growth profitability companies, you'd say it's going to be less than 772. If you voted for growth companies, it's going to be more than 772. So now we're talking about growth, and there we see high growth companies generated more than 3 times the benchmark return. Investing in these high growth companies caused $100 million to grow to be 1,178. That's a 13% annual return, 3 times the performance of the benchmark. So if you had a choice, as I asked you to choose, between growth and profitability, choose growth. A company that's growing is a company that is increasing its value in the stock market, and therefore we could assume that the increase in value we see in the stock market would be the same if the company was unlisted or listed in the stock market. So let's sum that up. High profitability companies generated 10% return. High growth companies generated 13% annual return. So things are getting better. So the conclusion, universe ended with 342, up 5%. Highest profitability companies ended with 772, which was up 10%. Highest growth companies ended up with 1178, up 13% per year. So between profitability and growth, you want to go with profitability. Now, what if each year we invested in only the companies that rank best for profitability and growth? The strongest, fastest, or the highest profitable growth companies. Well, there's our strongest, fastest guy. We would be rebalancing that group of stocks each year, kicking out companies that had fallen in their combined profitable growth ranking and adding companies that had risen to the highest profitable growth ranking. So, would the combined measure of profitable growth yield a higher return than profitability? And what about growth? So, would we end up with more or less than 342, more or less than 772, or more or less than 1178? What's your choice? Tick-tock. All right. So, high profitable growth companies generated almost 10 times the market return. Investing in high profitable growth companies caused $100 million to grow to $3 billion. That's a 19% average annual return, or 10 times the performance of the universe. So, if we can, choose profitable growth over both growth and profitability. So high profitable growth companies yielded the highest average annual return of 19%. So what have you learned? High profitability, strongest companies grew to be more than 2 times the value of the benchmark over the study's 20 years. 10% annual return versus the benchmark's 5%. High growth or fastest companies earn more than 3 times the market return at 13%. Prefer high growth companies over high profitability companies. But high profitable growth, or as I say, strongest, fastest companies generated 10 times market return over the past 20 years. 19% annual return compared to 5% for the benchmark. Companies with highest profitable growth scores were the most valuable. So there you have it. That's section 3. Next up is part 4. I'll see you there.